Over here we learn about balance sheet and how do we make one. As we have seen in our accounting equation, it is also known as a balance sheet equation. This is because the balance sheet is another way of representing the accounting equation. The balance sheet is a statement of financial position at a certain date, at a certain point of time. Over here we learn how to put the accounting equation in the format of the balance sheet. We'll use our example of Jim to understand this. Let's give Jim's business a purpose, such as Jim's Bakery. So I write on the top Jim's Bakery, and then I write balance sheet at a particular date, such as I've written 1st January 2019. That's when Jim's business starts. So how did Jim's business start? He invested. First of all, let me explain you the format. On left side we have all the assets in our balance sheet, and on the right side we have all the liabilities. There is no separate column for capital because capital is considered as a liability, because that is what you owe to the owner. Going forward with our example, on 1st January, Jim invested capital of $80,000. As you can see that's added on the left side column, on the right side column. And on the asset sides, we have two things added, premises and cash, worth $30,000 and $50,000 respectively. Then on 2nd January, the business bought a new machinery. As you can see, that is added on our assets column, and the cash has been deducted by $20,000 because we bought machinery worth $20,000 using cash. Then going forward, on 3rd January 2019, we bought $3,000 worth of inventory. So as you can see, assets column is increased by $3,000 with inventory, whereas the liabilities column has increased also by $3,000 with the trade payables. You can see over here that our accounting equation is matching. All our assets is equal to all our capital plus liabilities, 83,000, 83,000. Going on further, on 7th January, we saw one more asset was added, whereas one was decreased, such as we sold $2,000 worth of inventory to a client. So our inventory decreased to $1,000, whereas our trade receivables was introduced of $2,000, which is the expected income from our client. Whereas our capital liability remains same at $83,000. So this is how we represent our accounting equation as a balance sheet. It shows the assets, capital and liabilities on a certain date, which is our balance sheet. But as you see that this is for every single transaction we are making a new balance sheet, which can become extremely tedious. So what we do generally is only make the balance sheet once a year or once a quarter, means every 3 months. So on regular intervals of time, but not after every transaction. And there's a completely different format for that type of balance sheets, which we'll learn further. But this was for understanding the accounting equation. Thank you so much.